Below, I define some of the key terms that everyone should get to know when they start to take their finances seriously. These definitions are split into 5 categories: basic investments, basic insurance, personal taxes, retirement, and estate planning.
Basic investment. What is an asset class? An asset class is a group of investments with similar characteristics, and all the investments are subject to the same laws and regulations. They are organized by how assets perform in their respective markets. While the investments with each class are similar to one another, each class is distinct with its own risk, return, and liquidity profile. Investors commonly invest in multiple asset classes to diversify their portfolios to spread their risk and increase their potential returns.
Types of asset classes. Here are the 5 primary asset classes and investment vehicles. Number 1. Cash and cash equivalents. Cash is the direct ownership of a government-issued currency. This may take the form of physical cash, which is bills or coins, or digital cash, for example, bank account balances. Cash equivalents are short-term investments that are easily liquidated, carry low risks of loss, and have active marketplaces to ensure quick transacting. These instruments can easily be converted to cash, but are classified differently because they are not actual claims of ownership of cash. An example of cash equivalents are savings accounts and fixed deposit accounts.
Number 2, bonds. Bonds or fixed income securities are loans that are split up into units and sold to investors. Investors provide the principal upfront and then receive interest payments until the security matures. At maturity, investors are repaid the principal. The principal does not increase in value over time the way equity would, but fixed income securities should provide predictable income.
Number 3, pooled investment schemes. Pooled investment schemes are funds in a portfolio from many individual investors that are aggregated for the purposes of investment. Mutual funds, hedge funds, exchange-traded funds, ETFs, pension funds, and unit trusts are all examples of professionally managed pool funds. Investors in pool funds benefit from economies of scale, which allow for lower trading cost of investments and diversification.
Number 4, equities. Equities are shares of ownership in a company, also known as stock. The value of equities can rise or fall based on your company's performance, investor demand, and other factors. Ideally, equities increase in value over time, creating returns for investors. Some equities also pay dividends at regular intervals. Number 5, alternative investments. Alternative investments is a catch-all asset class for anything that's not cash, equities, or fixed income. Real estate, precious metals, cryptocurrency, and peer-to-peer loans are alternative investments.
Each asset class has its own characteristics and risks, and investors should carefully consider their investment goals, time horizon, and risk tolerance before investing in any particular asset class. A well-diversified portfolio that includes a mix of different asset classes can help investors manage risk and maximize returns over the long term.
Asset allocation. Asset allocation is the process of dividing an investment portfolio among different asset categories, such as equities, bonds, and cash. The allocation should be based on your investment goals, risk tolerance, and time horizon. Diversification. Diversification means spreading your money across different types of investments in order to reduce your risk. For example, instead of investing all your money in one stock, you might invest in a mix of equities, bonds, and real estate.
Wrapper. A wrapper consists of a combination of pooled investment schemes, including unit trusts, held in specified proportions to achieve specific investment goals. This portfolio is managed or wrapped according to a specific mandate. Compulsory and discretionary wrappers exist. Examples of compulsory wrappers is retirement plans, preserver plans, and retirement income plans. Examples of discretionary wrappers include endowment plans, guarantee plans, global plans, and flexible investment plans.
Clients like you and me would normally invest in a wrapper managed by an investment firm that consists of a combination of pooled investment schemes.
Risk versus return. Investing involves taking on some level of risk in order to potentially earn a return. The more risk an investment carries, the higher the potential return, but also the greater the potential loss. Time horizon. Time horizon refers to the length of time over which an investment is made or held. Long-term investments such as retirement accounts typically have a longer time horizon and can afford to take on more risk, while short-term investments such as saving for a down payment on a house typically have a shorter time horizon and should be less risky.
Compound interest. Compound interest is the interest on a loan or deposit calculated on both the initial principal and the accumulated interest from previous periods. It can help grow investment over time. A powerful example of compound interest is that if you invest 4,000 Rand a month into a pooled investment scheme like an ETF, with the assumption that your investment grows with 10% every year, you will have your first R1,000,000 after just over 11 years. Now here's where the magic of compound interest happens. You will have your second million after a mere 5 additional years. 6 years less than your first million, and your third million after only another 3.5 years, and your fourth million after only just over 2 years. It is important to remember that your first million is the hardest to create. Once you have your first million, it gets easier after that. And if this doesn't get you excited to start saving, nothing will.
Inflation. In the context of personal finance, inflation refers to the general increase in the prices of goods and services over time. It is a measure of the rate at which purchasing power of money decreases. In other words, as inflation rises, the same amount of money will buy less goods and services than it did before.
Inflation can have a significant impact on personal finances as it can erode the value of savings and investments over time. For example, if the inflation rate is higher than the interest rate on a savings account, the value of the savings account will decrease in real terms. Similarly, if the inflation rate is higher than the return on investment, the investment will not keep pace with the rising costs of goods and services.
To counteract the effects of inflation, individuals can invest in assets that have the potential to appreciate at a rate higher than the inflation rate, such as equities, real estate, or precious metals. Additionally, they can also use inflation-protected savings vehicles, such as inflation-protected bonds or treasury inflation-protected securities, also known as TIPS, that provide a return that is adjusted for inflation. It's important for individuals to be aware of the inflation rate and to factor it into their financial planning. This way, they can make informed decisions about their savings, investments, and spending.
The time value of money. In the context of personal finance, the time value of money, TVM, refers to the idea that money has a different value at different points in time. Specifically, that a dollar or a rand received today is worth more than a dollar or rand received in the future. This is because money received today can be invested and can earn interest, while money received in the future cannot.
TVM is a fundamental concept in personal finance as it is used to determine the present value and the future value of cash flows. The present value is the value of a future cash flow today, while the future value is the value of a present cash flow at a future date.
The time value of money is important for financial decisions such as investments, saving, and retirement planning. It helps individuals understand the opportunity cost of spending money today versus saving it for the future. For example, if an individual is considering whether to save 100 Rand today or to spend it, the time value of money will tell them that if they save it, it'll be worth more in the future because of the interest it earns.
Additionally, TVM is also used in the calculation of financial metrics such as net present value, also known as NPV, and internal rate of return, also known as IRR, which helps in evaluating the profitability and feasibility of investments.
In summary, the time value of money is a fundamental concept in personal finance, and understanding it can help individuals make informed decisions about their savings, investments, and spending.
Premium. The amount of money an insurance policyholder pays, normally monthly, to the insurer in exchange for coverage.
Coverage. The amount and type of protection that an insurance policy provides to the policyholder. Deductible. The amount of money policyholder must pay before the insurance coverage kicks in.
Policy limit. The maximum amount that an insurance policy will pay out for a particular type of loss or damage. Risk. The likelihood or chance of an event occurring that could result in a loss or damage that would be covered by an insurance policy.
Underwriting. The process that insurance companies use to evaluate and assess risks associated with providing insurance coverage to a particular person. Claim. When assets that are covered by an insurance policy are lost or damaged, the policyholder fills out a claim for the insurance to pay out the right amount of money for the lost or damaged items.
Insured. The person or entity that is covered by an insurance policy. Liability. Legal responsibility for harm or damage caused to another person or property, which may be covered by an insurance policy.
Exclusions. Specific conditions or situations that are not covered by an insurance policy. Policyholder. The person that owns an insurance policy and is responsible for paying premiums.
Insurer. The company or organization that provides insurance coverage and assumes the risk of loss. Peril. An event or circumstance that may cause a loss or damage and is covered by an insurance policy. Endorsement. A written agreement that modifies the terms and conditions of an existing insurance policy.
Indemnification. The process by which an insurance company compensates a policyholder for a loss or damage covered by the insurance policy, typically by providing financial compensation or repairing and replacing damaged property.
Personal taxes, taxable income. The amount of your annual income that you have to pay tax on after you applied all your allowable deductions and exemptions. Tax deductions. Expenses that can be subtracted from taxable income to reduce the amount of tax you have to pay, such as medical expenses, retirement contributions, and charitable donations. Tax exemption. A tax exemption excludes certain income, revenue, or even taxpayers from tax altogether.
Tax credits. Amounts that can be subtracted directly from the tax owed, reducing the total amount of tax payable. Examples of tax credits in South Africa include the primary rebate and secondary rebate. Tax brackets. The percentage of tax you pay on your salary. The more you earn, the higher your tax bracket and the bigger the percentage of tax you have to pay. Tax year. The period of time for which tax are calculated and assessed, which in South Africa runs from the 1st of March to the 28th or 29th of February of the following year. Tax season. The period during which individuals must file their tax returns with the South African Revenue Services, also known as SARS, which typically runs from July to November of each year.
PAYE, pay as you earn. The system employers use to subtract tax from their employees' salaries every month, which they pay over to SARS every month on behalf of their employees. Provisional tax, advance payments of income tax that individuals who earn income other than salaries or wages must make to SARS twice a year. Capital gains tax, a tax on the profit made from a sale of an asset such as a property or shares. It is important to consider your yearly capital gains exemption before paying tax on your capital gains income.
Dividend tax. A tax on the income earned from dividends paid by South African companies. It is important to consider your yearly dividend exemption before paying tax on your dividend income. Interest income. The income earned from interest-bearing investments such as savings accounts and fixed deposits, which is subject to income tax. It is important to consider your yearly interest exemption before paying tax on your interest income. SARS, the South African Revenue Services, the government agency responsible for collecting taxes and enforcing tax laws in South Africa.
Tax residency, the system countries use to determine in which country an individual should pay tax. This depends on factors such as their physical presence in the country and their sources of income. Tax clearance certificate, a certificate issued by SARS to individuals who are up to date with their tax obligations and have no outstanding tax liabilities, which is often required for certain business transactions or contracts.
Tax avoidance, the legal practice of arranging one's financial affairs in a way that minimizes tax liability. Tax evasion, the illegal practice of not reporting or underreporting income to avoid paying taxes, which is subject to penalties and fines in South Africa.
Retirement age, the age at which an individual stops working and begins to receive retirement benefits, which varies by country and employer. Pension plan, a retirement plan that provides a fixed income for an individual in retirement, typically funded by the employer and/or the employee.
Annuity, a financial product that provides a fixed income stream for a specified period of time, typically purchased with a lump sum payment or series of payments. Fixed annuities provide predictability and stability in income, making them suitable for individuals looking for a reliable source of retirement income.
Defined benefit plan, a type of pension plan that guarantees a fixed retirement benefit based on a formula that takes into account factors such as years of service and salary history. Defined contribution plan, a type of retirement plan where the individual contributes a portion of their salary to an investment account with the eventual retirement benefit depending on the performance of the investment.
Difference between a defined benefit and contribution plan is what each plan promises its participants. A defined benefit plan specifies exactly how much retirement income employees will get once they retire, regardless of your contribution. A defined contribution plan only specifies what each party, the employer and employee, contributes to an employee's retirement account, and you are only eligible to the combined contribution plus growth. Longevity risk, the risk that an individual will outlive their retirement savings due to increased life expectancy and/or inadequate savings.
Retirement savings rate. The retirement savings rate refers to the percentage of an individual's income that is allocated towards retirement savings, typically through retirement accounts, investments, and other saving vehicles. A good aim is to save 15% of your income for 25 years, which should give you close to 75% income of your final payslip for the duration of your retirement.
Estate planning. Will. A legal document that outlines an individual's wishes regarding the distribution of their assets after death. Estate. The total assets and liabilities that an individual owns at the time of their death.
Executor. The person appointed in a will to manage the distribution of an individual's assets after their death. Probate. The legal process of verifying and distributing an individual's assets after their death, which may include paying off debts and taxes, distributing assets to beneficiaries, and transferring ownership of property.
Interstate, the condition of dying without a valid will, which can result in the distribution of assets being determined by law rather than the individual's wishes. This should be avoided by having a legal will in place. Trust, a legal arrangement where assets are held and managed by a trustee for the benefit of a beneficiary or beneficiaries, which can be established during an individual's lifetime or after their death.
Estate tax. A tax on the total value of an individual's estate at the time of their death, which may be levied by the government in some countries. Inheritance tax. A tax on the transfer of assets from an individual's estate to their heirs, which may be levied by the government in some countries.
Power of attorney. A legal document that grants another individual the authority to act on the individual's behalf in financial or legal matters which can be used in situations where the individual is unable to make decisions for themselves. Beneficiary, an individual or organization named in a will or trust to receive assets or benefits after an individual's death.